Hello and welcome to another episode of IJS Speaks. This is your neighborhood financial economist, Katie Mark, and today is November 26th. It is 3:15 p.m. Eastern Standard Time, and for those listeners in the United States, happy Thanksgiving, happy Turkey Day. For everyone else, sorry that volume was kind of low today because the U.S. market was closed. Okay. So now, being that the U.S. market was closed, volumes for a lot of instruments were really low, and some instruments didn't move at all. But I did notice that the 10-year Treasury, a couple positions that I have on the 10-year Treasury, were actually responding to really small price changes. So there was a little bit of liquidity, out there for the 10-year Treasury, at least today. So that's always interesting. So let's jump right into the dashboard. Okay. And what I'm looking at on my trading dashboard, my staples are the S&P 500. I've got crude oil, got the 10-year Treasury, the dollar index, and gold. For some of you who have been listening to previous episodes, you may notice that the order in which I read those off is a little bit different. And this, of course, again, as markets are fluid, this changes from time to time. What I noticed this week is that the 10-year Treasury started behaving more like a risk asset, while gold started behaving like a safe haven asset. So what we basically end up happening this week, or have had happen this week, is for risk assets, I only look at the S&P 500 and crude oil, and for my safe haven assets, for my analysis, I look at the 10-year Treasury, the dollar index, and gold. And just to highlight, by the way, the dashboard is indicating a risk-off sentiment. So what I'm looking at is, first of all, my risk assets, the S&P 500 and crude oil, since, let's just call it late Tuesday, early Wednesday for the S&P, and late Wednesday for mid to late Wednesday for crude oil, they started retracing some of the ground that they've been making since mid to late last week. And at the same time, my safe haven assets in the 10-year Treasury, the dollar index, and gold, they were falling for the latter half of last week and the first half of this week. And around Wednesday to early Thursday, except for gold. Gold seems to have made its pivot point as early as Tuesday. But they all started retracing. Last to the party, of course, being the dollar index, which seems to have made its pivot late yesterday into early today. So I'm assuming the European session. But I do also want to note that granted, all of the instruments on the dashboard that I'm looking at are retracing. So we're basically seeing weakness in the S&P, weakness in crude, and a little bit of strength in the 10-year, strength in the dollar, and a little bit of strength in gold. I would like to note that as a way of kind of measuring the scale, I guess, of the retracement, I like to use a simple Fibonacci retracement study. And on all 5 of the Fibonacci retracement studies, just looking back over a week's worth of data, none of the prices have yet to retrace to the 50% level. So, for instance, with the risk assets in the S&P, so far as of now, the prices retraced to the 38.2% on the Fibonacci. So the 50% retracement level would put the S&P 500 back to around 3,600 for reference. It's currently at 3617. So it's not a whole lot of movement down. But that would be more than likely the next level of support if the weakness in the S&P 500 holds as Asia comes online for the Friday session, then Europe, and finally the United States and the Americas come online. If that weakness holds, then the next support level would be at the 50% retracement on the Fibonacci, which would put the S&P at about 3,600. From there, if that breaks, then probably the next significant level would be about 3560 to 3550. Similarly, on crude oil, the retracement on the Fibonacci just broke the 23.6 and is hovering above the 38.2. And again, if the weakness continues as the into the next 3 trading sessions, the Friday trading sessions, then the support level at the 50% retracement for crude oil would put it just under $44 a barrel. And so about $43.75. And for reference, it's currently sitting at $44.99. So not a lot of room below it, but still some room below it. If, again, the weakness continues into the Friday trading session or carries over. Similarly, with the 10-year, dollar index, and gold, they're all retracing. The 10-year Treasury has gotten the furthest along in its retracement. It is piercing the 38.2 level on its retracement. The dollar index is still below the 23.6, just getting started, as is gold, hovering around the 23.6. So again, if the weakness or the risk-off sentiment carries into the Friday session, then we can probably see the 10-year increasing to about 138.55. It's currently trading around 138.20. And that should put it about the 50% on its retracement, and that should provide some kind of resistance. Similarly, with the dollar, it's currently trading at about 92.02, and the 50% retracement would put it somewhere in the range of 92.32. So again, a little bit of room for appreciation in the 10-year in the dollar. And gold, lastly, which is currently trading at around 18.15, at its 50% retracement, would put it about 18.37, so just under 18.40. So going into Friday, if the risk-off sentiment continues, then we will see a little bit more. of these prices moving in that direction, which which works out perfectly fine for me because I've got my options on the SPY, GLD, and the 10-year Treasury, which all expire tomorrow. So going into the Friday session, I would like to see those prices continue trending in the direction that they are trending in, which should trigger some of my options uh, that I hope to close out profitably tomorrow. Okay, so that's the dashboard. That's what the market sentiment is hinting at right now going into Friday. Now I'd like to talk about the trade book for a little bit. So left on the trade book, I've got the 10-year Treasury, which is the futures contract, and I have a straddle on that contract. But I was looking at a chart pattern of the price action on the 10-year Treasury, and I was convinced that the move would be to the upside. So starting with my initial straddle, or actually in this case it was a strangle, because I've got my call strike at 138, and then my put strike at 138.7. But starting with the initial call, the initial strangle, I went ahead and tacked on another call option. This one with the strike of 38.5. It was very cheap to get the option simply because of the time when I bought it. The market had been flat or consolidating for a little bit. So I guess the probability of that option expiring in the money was fairly low, so I was able to acquire it for fairly cheap. So my net exposure to the 10-year going into the Friday session is long. So I've got a net long, but a little bit of coverage with a put option, just in case. But even though as of this recording, the 10-year Treasury price is at 138 and 15, so at least one of my call options is in the money. And again, we'll see how that holds going into the weekend. Going into the Friday session. Hopefully, the price movement maintains its trend direction, and this can be a profitable trade closing out the week. I also have, as I mentioned, the SPY. I've got a strangle. There you go. Yeah, I've got a strangle on the SPY. I've got a call with a strike of 364, and I've got a put with a strike of 361. Current theoretical price on the SPY is about 363.13. So that puts it right smack dab in the middle. Maybe a little bit closer to the put, but still smack dab in the middle. So just time value eating away on those options, waiting for some kind of movement as markets come back to life tomorrow morning at the start of New York. Similar idea with the GLD. I've got a strangle, got a put strike 169, call strike 170. Current market's at 169.74. So not so smack dab in the middle, but still in the middle of my strike. So just time value eating away. Would like to see some movement in gold, especially towards the open of New York in the morning. And also, for those of you who can, I like doing the options on on the ETFs like SPY and GLD, because you can get the exposure for a little bit cheaper. But sometimes if it's within your buying power or it's within your budget, within your portfolio, it's worth it to get the options on the actual futures contracts. Liquidity one, much deeper, and also less restrictions on trading. Futures, you would be able to liquidate those options fairly close to 24 hours a day during the normal trading week. The options on the equities, you can only buy and sell during market hours of the session where the equities are listed. So in my case, the New York session is the session that I can buy and sell out of my equity options. So on days like today, or even for overnight volatility, sometimes if it's within your buying power or if it's within your budget, it's worth it to go with the options on the futures. And lastly, I've got my corn contracts. So I'm learning a little bit about the futures markets every day. And it seems like being in a rush to set a hedge in a moving market, I overlooked the fact that my hedge expires in 4 days. Now that's 4 days including weekends, so it's technically only 2 more trading days, which is all good and well because I can always just roll the contract over, except that the other leg on the trade would be the next contract. So I'm not too sure what happens if I try to roll over a long position and I already have a short position in that month. But we're about to find out. I'll keep you guys updated as to how that plays out. But continuing with the theme of missed opportunities from last week, completely missed time corn, and mistimed the hedge. So now I just basically locked in again a wide loss. My underlying trade at last glance was moving in the right direction, but the hedge again was taking it off the books, while also running into liquidity issues as the contract expires in a few days. And lastly, with the trade book, I have no spot forex positions open at the time. If I'm not mistaken, spot forex was moving, or at least there was thin volume throughout the day today. Last week was very, very choppy. I played the commodity currencies, I played the Canadian, played the Aussie. I think I was stalking the New Zealand for a little bit. I don't think I ever pulled the trigger on that one. But long story short, it was a very choppy trading week. I made no progress and actually lost ground trading forex, spot forex this week. So, but what I also because it's been a while since I've traded spot forex. What I had learned to do, or what I was reminded of, was the importance of time frames. In that, when it comes to trading spot forex, it is a scalper's market. It is best done at a time frame that is very short, with data that is very frequent, and it requires your full attention. So I guess trading forex would be akin to having a knife fight. You know you're gonna get cut, but you also know the other guy's gonna get cut too. So yeah, that pretty much sums up what where the trade book is now compared to where we started the week. The options roll off tomorrow, whether they're profitable or not. Also closed out the Euro US dollar futures positions. That too was also at a loss. I was receiving conflicting information from my longer term charts and my shorter term charts. And the conflicting information was causing me to make too many trades. So I decided to realize the loss on that one and step back from that market. Similarly with the spot forex market, because of the volatility that I was experiencing with the currencies. But currencies aside, other sections of the financial markets are functioning as close to normal as possible, I would say. So there's still opportunity out there, and I am still looking to trade that opportunity. Okay, so that's the trade book going into the Friday session. And now let's revert back to the dashboard, and let's see what I can surmise from the dashboard. So, like I said before, looking at the risk assets, the S&P and crude oil prices, they are both, actually all 5 instruments are in a retracement pattern. Okay? Leading up to the pivoting of these prices, the markets were trending in a strong risk on. So the risk assets were appreciating, and the safe haven assets were depreciating. The recent pivot that these prices are that formed the turning point for the retracement, when looked at differently, all seem to be highlighting a bull flag pattern, or in some cases bear flag pattern, which also it's a good point to highlight the importance of understanding or being able to utilize different types of technical analysis, because in the short term, looking at what the market is doing, the prices were moving in one direction, they hit a point, they turned around, and I'm measuring the retracement using the Fibonacci ratios as a standard. Inevitably, this retracement or this pause ends, and the prices return to their underlying trends, which would be risk on. Now, to gauge that turning point, instead of looking at a technical indicator or a technical drawing like the Fibonacci retracement, I would look at a chart pattern. And I see the bull flag pattern, which basically is you have the price trending, and as the retracement begins, the retracement forms a channel. And I simply just highlighted that retracement channel. And the price is meant to travel within that retracement channel to its next pivot point, which in most cases would be the 50% retracement on the Fibonacci. But at that point, investors need to decide whether the underlying trend has enough momentum to continue, or if that Fibonacci level gets broken, then we're not just looking at a retracement, we're looking at a reversal. But as of now, I am gauging this as a retracement. More than likely, markets retrace into the end of the trading week. Maybe the sentiment holds into the start of next week, but the idea is maybe sometime around Monday, Tuesday, maybe even as late as Wednesday, markets reverse, get back to a risk on mode, and then you see the bull flag pattern breakout, where in case of the S&P and crude oil, you would see the prices break higher out of the channel, and in the case of the 10-year, the dollar, and gold, you would see the prices break lower out of the channel. So that's the forecast from the dashboard going into next week. But it is also contingent on the prices getting to the 50% retracement on the Fibonacci. And if that level holds its support, and then the prices continue back in the direction of the original trend, then we can measure this as a retracement and then look to play the breakout going into next week or through the next week trading session. But if and when the prices get to the 50% retracement, they break through it, then what we're looking at officially would be a reversal, and targets would have to be changed. Trades may need to be reversed, losses may need to be realized, but it will be a clear indicator that the price is no longer doing what we initially thought it was going to do, and we would have to adjust the trade book at that point. So not every week is going to be a winning week. There are weeks that are losses. Last week, for the most part, traded all week, paid a lot in commissions to trade all week, and overall ended the week flat. So that happens. A couple weeks before that, a couple weeks running before that, I was able to have some profitable trades. So comes with it. That's the game. That's the game. That's the game. That's the job. That's the job of a trader. Okay. And on that note, I'll leave it there. After all, it is still Thanksgiving. It is still Turkey Day. So let everyone get back to the celebration. And like I said, when in doubt, take profits. I had several opportunities last week and earlier this trading week that, missed opportunities to take profits. So, and in some cases I actually got to watch medium-sized profits turn into small losses, which is disheartening. But I live, I learn, I do better. Okay, so for any questions, concerns, you can always contact me, reach out to me at contact@runthenumbers.biz. That's contact@runthenumbers.biz. And I will try to get back to you via email, or in some cases, if I can, incorporate your question into the next episode. But that's all for today. Happy trading. Take profits when you can. And see you next time.